Hey there, good evening traders. This is Trader Tim from E-mini Mind bringing you a Monday market analysis video. A little bit later here in the evening than I normally get the video out, but nonetheless a lot of good content to talk about. This week there's not a whole lot on the economic news front. Thursday, Friday we've got jobless claims and retail sales before the bell, so those could shift the market. But with things that do come out before the bell, we kind of have an idea of how the market's going to accept that information. So not a huge catalyst at this point. However, there's a lot of good things to talk about, a lot of good trade setups that are beginning to occur, and I want to get into those. Before I do that, there are a couple of webinars that I'm doing coming up, and those are going to be on Thursdays. Thursday the 14th, so this Thursday, I'll be doing a webinar talking about day trading futures with tick charts and Heikin-Ashi candlesticks. And the following Thursday, next week, January 21st, I'll be doing a live trading session. And that'll just be at the open for a couple of hours. So you can tune in and watch me trade. We'll talk about the markets, see what's going on, place some trades, and take some questions. The registration links I will put below in the comments, or in the details section rather, of this video. You can also find those webinar links at eminimind.com. So let's start by talking about the ES, and please excuse my slight cold that I'm getting over. Got a weekly chart of the S&P, and you can see how we broke the 50% retracement, that we weren't really opinionated one way or another. We were just drawing from lows to highs and seeing if we would get some sort of a bounce. If I pull up the SPY, and I'm going to go to a 5-year chart just so we can see, kind of the rollover effect, maybe even a monthly, that we're getting, where you have this high area. And so this is the SPY, so we can see volume, but let's go to the SPX, and I'll go back to a weekly. So you can see how we've got, a very rounding to flat, rolling over formation up here, but we really have not broken any major trend lines. At least here on the larger context of the S&P. Sure, we ended 2015 pretty much flat on the year. We started off 2016 with a pretty bearish week, but in the larger picture, we're still generally uptrending, and so I wouldn't expect a huge amount of bears necessarily coming in until we start to break some of these swing lows. So let's go to a little smaller time frame in the daily and take a look at some of the volume. And you can see that last week, the start of the year, we don't have typically quite as much volume. The first couple of weeks are usually a little bit slow, so there's still a lot of traders, a lot of money on the sidelines. And we did come down and start to break this consolidation that we were in from November and December, but these major swing lows that are back here in September, October, still intact. One really interesting thing to look at is, if you take a look at where we came down here on the S&P as related to the mid-December and mid-November lows, and then if we come over and look at the volatility index, you can see that the VIX has really only rallied to the mid-20s, to the same point we were at in December. And if we go back to the S&P, well, that point in mid-December was much higher than we are now. So as the market has gone lower, we should expect the volatility index to go higher than that previous swing low, but we didn't. We just, basically double topped here on the volatility index. So that's telling me that, this decline, or at least this temporary pullback, is not super sustainable. There's not a ton of follow through in this. And, looking at the candle from today being a bullish hammer formation, I would definitely anticipate some sort of a bounce. Back here last week, we had the similar situation where we came down to lows and we got a bounce, and it kind of ended up being a fake out, which is why the decline following was so strong. So if you think about it, everyone who is getting long above this hammer's high, expecting us to fill the gap, once the market starts to break down and fail the daily low, now all of those longs, people that got long, are underwater, and now they're getting out of their positions quickly, typically with a computerized stop order. And that's when you get these big harsh moves, these gaps that kind of end up, when you look back on them, appear to be a fake out. So we've got an unfilled gap up here, and then back a couple as we move down as well. So a couple scenarios, it would be highly likely, seeing as we're down in the middle of the prior decline, that we have some support down here, and to push us back up to the prior support level here that would now be resistance. So as we draw our next trend lines here on the ES, I'm going to draw a full halfway back and see if we can get up into this short up here at, what do you know, the 2000 level. So now we've got a number of forces working in our favor, kind of giving us some indication that we're down here at support. We have the round number of 2000 above us. It happens to be a 50% retracement. If we go just to the weekly chart to keep it a little bit cleaner, you can see how we've got this resistance level down here, as well as up at the 2050 level, but the 2000 being a very strong resistance level, as it was a support level. So I'm looking for a bounce up to the 2000 level, and then to take us down into the 1840 level. There's a lot of good day trading to be had in this mid-20 volatility range, and we did have a slight bounce at the retracement, and I'm going to just back up quickly and just show you that setup on the 15-minute chart. So we came last week, we came down to the 50% retracement, the long setup, and you see we did get a small bounce. And while we didn't get a lot of follow through, the fact that we got a bounce, and the fact that when I go to a 15-minute chart, you can see that we traded lower right to the tick, and then we had a nice 15-minute move. Even though it was the end of the day, what this is telling me is that the computer systems, the algorithms, the other traders out there are looking at similar levels, whether they're looking at it because it's a 50% retracement or the fact that it's a round number. The key is that we're getting reactions at these levels. So that means that the trading as we continue forward is likely to be very technical, meaning we're likely to hit certain levels and get nice bounces, and that's typically what leads us into a nice clean series of 15-minute retracements, gives us a lot of nice small 5-12 tick setups. And when we get into that kind of environment, it makes for really great trading opportunities. So, jumping back ahead, we're going to be looking for a short setup at the 2000 level because we are now down here at support, and we have a hammer formation on the day. So we'll be looking for the S&P to break today's highs, so tomorrow, Tuesday, we'll be looking for a break of today's highs as a catalyst to start pushing the market higher. And when we go to various other stocks like Google, go to a 6 months, so it's a little bit larger. You can see a nice little dragonfly hammer. Let's see what Amazon's doing. Yep, same scenario. Netflix already had a little bit of a bounce earlier last week, but we're getting a nice little bull flag. Let's take a look at some other bigger names. Abbott Laboratories, same kind of thing, getting a hammer. FedEx was trending lower, so that one is kind of, if you were looking for short to balance your portfolio of longs, I would anticipate FedEx to be one of those that let it lift itself with the rest of the market and then look to take a short. Home Depot not looking too bad, a little bit off highs, but again, kind of a bearish scenario right here with the higher volume. So because Home Depot has started to break its uptrend, I would look for it to rise with the market if we get a bounce, and then look to take a short. Earlier, a couple weeks ago, we were looking for a continuation in the long, but we were never really able to break those highs back here. Instead, we rolled over. So, I go through some of these bigger names like Amazon, Google, Apple was kind of in the same scenario as FedEx. So letting the market rise all the ships, and the stocks like Apple might get a little bit of a bounce, but because they're downtrending, they're relatively weak. I would look for a short play potentially here in Apple. So in the week ahead, we're going to look for a break above the candle here of today, Monday, the daily candle. Look for a nice series of 15-minute setups, 15-minute retracements on the smaller time frames, as well as the 512 tick chart to execute trades. But as a bigger picture, looking for that bounce up to 2000 and then a break down to 1840s. And then from there, it's very likely that we'll bounce between the 2000 and the 1840 level for quite a while. It could be, most of the spring. If we do start to break the swing lows, these major lows from back here, now we've got some bigger catalysts to push the market, and we could potentially see some really big selling if these lows start to break. But as long as we kind of stay within this support and resistance level, now we're just kind of bouncing back and forth, looking at shorting up at 2000s, looking at taking longs down at 1840s. So, knowing the context of the larger daily chart, when we zoom into placing day trades in the intraday time frame, is very important. It can be very helpful to know where we're at. So if you want to tune into some live trading next week, Thursday, and this week we'll be talking about how we use tick charts and Heikin-Ashi candlesticks to execute trades. So you can find those over at emoneymind.com. And if you have questions, feel free to shoot me an email, tim@emoneymind.com. Thanks a lot, and we'll talk to you soon.